Hey everyone, welcome to a new video. Before we start, the usual disclaimer. What you hear here is not financial advice. I'm just sharing my thoughts and analyses. You make your investments at your own risk, okay? Yesterday, we got the eagerly anticipated interest rate decisions, and surprise! Interest rates were cut by a whopping zero point 0.5 percentage points. Now everyone's asking, is the stock market going to skyrocket, or is the dreaded recession coming? In this video, I'll give you my assessment, backed up with facts and historical comparisons. First off, what does this interest rate cut actually mean? When the central bank lowers interest rates, money becomes cheaper. This means companies can take out loans at lower costs, which is supposed to stimulate the economy. For us investors, this often means stocks become more attractive because bond yields decline. But be careful, it's not always that simple. Okay, let's look at the current market reactions. The major American indices, S&P 500, NASDAQ, Dow Jones, are all up over 1%. The NASDAQ has even gained 2.4%. Not bad, right? This shows that many investors have responded positively to the rate cut. But is this really sustainable? More on that later. It's similar with cryptocurrencies. Bitcoin is up over 5%, Ethereum over 6%, and Solana has gained almost 9%. That's quite something. But be careful. Cryptos and stock indices are two different pairs of shoes. Just because stocks are rising doesn't mean cryptos automatically follow suit. They often behave differently and react to completely different factors. Cryptos are known for their extreme volatility. It can go both ways and fast. By the way, our YouTube portfolio is doing really well, up 28%. We're almost at the all-time high from May 20th, which was 31%. This shows that our strategy has been working well so far. But remember, past performance is no guarantee of future results. We need to stay vigilant and constantly review our strategy. Yesterday's 0.5% rate cut was a 50-50 thing. Some experts had predicted 0.25 points, others 0.5. With the 0.5 points, the Fed shows that it's taking the recession risk seriously and wants to act quickly. A recession, by the way, is simply a phase where the economy shrinks instead of grows, and that for a while. Typical signs are rising unemployment, declining consumer spending, and less investment from companies. The tricky thing is, often you only realize in hindsight that you were in a recession. This week, until Friday, the market could continue to rise. Why? FOMO, the fear of missing out. Many small investors are now betting on falling interest rates and rising prices. That's why the market started so strong. But be careful. This could backfire for many. FOMO is a dangerous advisor in the stock market. It often leads to investors buying at peak prices and then being frustrated when it goes downhill afterward. Let's take a look at the past. An interesting newsletter compared the effects of interest rate cuts. With a 0.25-point cut, the S&P 500 averaged 10% gains in 3 months and 15% in 12 months. Sounds good, right? But with a 0.5-point cut, like we just had, it looked quite different. The S&P 500 lost an average of 15% in the following 12 months. Ouch. This shows how important it is to look not just at the rate cut itself, but also at the context and reasons behind it. Personally, I'm expecting an even stronger decline. In the next 8 months, it could go down by 30%. But don't panic, let's look at the charts. Here we see the comparison between the inverted yield curve and the interest rate. The yield curve, the difference between 10-year and 2-year government bonds, is an important indicator. Normally, long-term bonds have higher interest rates than short-term ones. When this reverses, it's called an inverted yield curve. This is often seen as a warning sign for an impending recession. Why? Because it shows that investors have more confidence in short-term than in long-term perspectives. This can be a sign that they see problems on the horizon. Historically, this has always been a warning sign. When interest rates were cut in the past and we had a positive yield inversion, the S&P 500 sometimes lost up to 45%. It was similar in 2007, even though it took a few months back then. Remember the financial crisis? Exactly. We had a similar situation then. Interest rates were cut to support the economy, but it was already too late. The recession couldn't be stopped anymore. What does this mean for us? Typically, the Nasdaq is already in a recession when interest rates are cut. The S&P 500 often follows a few months later with a substantial correction. This is because the Nasdaq contains more tech companies, which often react more sensitively to economic changes. Tech companies are often valued higher and are based on future expectations. When these expectations dim, things can go downhill quickly. For everyone panicking now, remember 2021. Everyone said it was going to go down further. And what happened? The people who didn't listen to the masses made a lot of money. In financial matters, you generally shouldn't blindly follow the herd. It pays to think for yourself and sometimes act counter-cyclically. This doesn't mean you always have to swim against the current, but it's worth questioning your own assumptions. Now to the action options. For the traders among you, there are two interesting short opportunities. Either you set a short with a range of about 11 to 12% up to 22,400 points, or you wait for a new all-time high and then go short, with a stop loss at 22,400. This could bring a profit of 21% to 35%. That's over 7,000 points. But be careful, shorting is risky. You can lose more than your stake if the market runs against you. So, do your risk management well. For long-term investors, if you hold a broadly diversified index fund, you don't need to panic sell now. But consider reducing your monthly investments a bit over the next few months. If the index then falls below 15,000, you can use the saved money to improve your average purchase price. This is also called dollar cost averaging, a strategy to balance out market fluctuations and avoid emotional decisions. One last point. There's a wild card in play, the presidential elections. The Fed could do everything to keep the indices high until the election date. Nobody wants a stock market crash right before the election. If the Nasdaq breaks 21,500, it could even go up to 25,000 or 26,000. But after that, it could really tumble. Politics and markets are closely intertwined, and sometimes political events can have stronger impacts than economic data. What does all this mean for you? First, stay vigilant. The current price increases could be a trap. Second, diversify your portfolio. Don't put all your eggs in one basket. Third, keep some cash ready. If the market really crashes, there are bargains to be had. So, that's it with my scenarios and facts. I hope I could help you with your decision-making. Remember, this is not financial advice, but my personal assessment. Do your own research and make your own decisions. Do you have questions or thoughts about this? Put them in the comments. And if this video helped you, hit the like button and subscribe to the channel for more finance content. In the next videos, I'll be featuring individual stocks and cryptocurrencies. So, stay tuned. Until next time, take care.